Picture this. It is a quiet Tuesday morning in early March 2026. A woman named Sarah is sitting at her kitchen table, coffee in hand, scrolling through her bank app on her phone. She has been working the same accounting job for 11 years. She saves diligently every month. She does everything the way she was taught. She pays her bills on time, avoids unnecessary debt, and keeps a healthy emergency fund in her savings account. By any reasonable measure, Sarah is financially responsible. But something on her screen makes her pause. She has $30,000 sitting in that savings account. And her bank, one of the largest financial institutions in the United States, is paying her 0.01% in annual interest. She does the math quickly in her head. 0.01% on $30,000. That works out to $3 a year. $3 on $30,000. Saved over 11 years of careful, disciplined work. Sarah puts her phone down and stares at her coffee, and she thinks, there has to be something better than this. She does not know it yet. But at that exact moment, she is not alone. At that exact same moment, $8.271 trillion, more money than the combined annual economic output of Germany and France, is quietly moving out of traditional bank accounts across the United States, moving away from institutions, just like hers. And it is doing so at a pace that is breaking every historical record ever measured. This is not a stock market crash. Nobody's panicking in the streets. There are no urgent news alerts on your phone. Bank branches are not being stormed. The tellers are calm. The ATMs are working. On the surface, everything looks normal. And that is precisely what makes what is happening right now so significant and so important to understand. This is the silent bank run, and it is rewriting the rules of the financial system in real time. Welcome. Stay with me through this entire video, because by the time we are done, how you think about where your money lives, what it is doing, and what is quietly happening around it will never quite be the same. Let us start with a question that most people have never seriously asked themselves. When you deposit money into a bank, where does that money actually go? Most people carry a mental image of their savings sitting somewhere safe, in a vault perhaps, waiting patiently for them to reclaim it. The reality is fundamentally different, and it is the key to understanding everything else in this story. When you deposit your savings at a bank, that institution takes the vast majority of your money and lends it out, to home buyers taking out mortgages, to businesses borrowing to expand, to developers financing construction. Your deposit becomes the raw fuel for the entire lending machinery that keeps the modern economy moving. Banks are not storage facilities. They are intermediaries, and the engine that powers them, the single most important input they have, is access to cheap deposits from ordinary people like you and Sarah. That is why what is happening right now is so consequential, because the cheap deposits are leaving. But here is the real problem. For the past 3+ years, Americans have been quietly, individually, one account at a time, moving their money somewhere else. Not into stocks, not into gold, not even into real estate. They are moving it into instruments called money market funds. And the scale of this migration, confirmed by data released in the first week of March 2026, is genuinely unprecedented in modern financial history. According to data compiled by Crane Data, total assets held in United States money market funds have now reached $8.271 trillion, a new all-time record. $8.271 trillion sitting outside the traditional banking deposit system. To frame that number in terms that land differently, that is more than the entire annual gross domestic product of Japan, more than the economic output of the United Kingdom and Germany combined in a single year. It is one of the largest single pools of liquid capital that has ever existed on Earth. And the growth is not slowing. Over the past 12 months, total money market fund assets have grown by $913.7 billion, nearly $1 trillion added in a single year. Assets have increased in 19 of the past 20 months. In the single week ending March 3rd of 2026 alone, $49 billion of new inflows entered money market funds. And on a single Tuesday, one day, $18.5 billion moved into safety assets as financial markets reacted to the escalating conflict involving United States and Israeli military action against Iran. This is the part nobody is talking about. To truly understand what is driving this and why it matters so much right now, I need to take you back in time. Because the most important financial stories are never new, they are echoes. And this one echoes something that happened more than 50 years ago. The year is 1971. The United States banking system is operating under a federal regulation called Regulation Q. This rule imposed a strict cap on the amount of interest that banks were allowed to pay their depositors. The original intention was reasonable: prevent banks from engaging in destructive competition for deposits that could destabilize the system. But here's the problem nobody anticipated. In the early 1970s, inflation began to rise. Interest rates in the open market climbed to 5, 6, even 7, and 8%. Yet banks, handcuffed by Regulation Q, could only offer their depositors a small fraction of that. The result was simple. Savers were being systematically shortchanged, and they began to look for alternatives. In 1971, the first money market mutual fund in history was launched in the United States. The concept was straightforward. Pool investors' cash together, invested in short-term, high-quality instruments, government securities, top-rated commercial paper, pass the market interest rate back to investors minus a small management fee, transparent, liquid, paying actual market rates. People called it a gimmick at first. Banks dismissed it. Regulators were uncertain about it. The public took years to warm up to it. But the math was undeniable. By 1979, total money market fund assets in the United States had reached $45 billion. 2 years later, by 1981, they had surged past $180 billion. The pressure was so intense that Congress eventually repealed Regulation Q because sustaining it meant actively harming tens of millions of ordinary American savers. Banks adapted. The system survived. But the lesson embedded in that era, that when you deny savers access to fair returns for long enough, the money will find another way, that lesson was supposed to be permanent. And this is where everything changes. Because in 2026, we are living through the modern version of exactly the same story. But the scale this time makes 1971 look like a practice run. The national average interest rate on a standard United States savings account right now is 0.43%. That is the average. The largest banks, JP Morgan Chase, Bank of America, are currently paying as little as 0.01% on basic savings accounts, according to publicly available rate data. 0.01% on the money that tens of millions of Americans have trusted those institutions to hold for them. Meanwhile, money market funds are offering annual returns of around 4%. United States Treasury bills, backed by the full faith and credit of the federal government, essentially risk-free, are currently yielding around 3.6%. The gap between what the biggest banks pay their depositors and what those same depositors could earn in the open market is nearly 100 times wider. 100 times. And it has been this wide for long enough that an $8 trillion migration has already begun. Sarah was not irrational. Sarah was doing math. Most people are missing this. Now let me tell you what the data actually says about who is moving and why. Because this is not a story about panicked retail investors making emotional decisions. It is a story about the coldly rational behavior of both ordinary people and the most sophisticated financial institutions on Earth. Of the $8.271 trillion currently sitting in United States money market funds, $4.73 trillion belongs to institutional investors, pension funds, insurance companies, corporate treasuries, sovereign wealth funds. These are entities that manage money on behalf of millions of people. Their decisions are deliberate, analytical, and long-term. And they began this migration years before the average American even knew money market funds existed in their current form. They studied the interest rate differential. They ran the models. They moved trillions, quietly, professionally. Without a press release, $3.08 trillion, just over $3 trillion, belongs to retail investors. People like Sarah. People with less than the institutional firepower, but with the same access to information and, increasingly, the same awareness of the gap between what their bank pays them and what the market is offering. This portion of the market has grown dramatically, driven in part by the fact that opening a money market fund account now takes about 3 minutes on a smartphone. The barriers to exit from traditional banking have never been lower in history. And this combination, massive institutional migration already complete, retail migration now accelerating, is what makes the current situation structurally different from past episodes of deposit competition. The money that left is not coming back the way it once did. But here is the real problem. The Federal Reserve has noticed. Between September 2024 and December 2024, the Fed cut its benchmark interest rate 3 times, 3 cuts. The stated goal of these cuts was, among other things, to narrow the yield gap that was pulling deposits out of banks. Lower rates should have made money market funds less attractive, brought the differential down, and encouraged deposits to flow back. The theory was sound. The execution did not produce the expected result. As of early March 2026, total money market fund assets have grown in 19 of the past 20 months, straight through every single rate cut. That has not happened before in the history of modern monetary policy. The structural migration appears to have taken on a momentum of its own. And this matters enormously for the banks that remain most dependent on traditional deposit funding, particularly regional banks and community banks, which do not have the trillion-dollar balance sheets of the largest institutions to cushion the pressure. This is the part nobody is talking about. Here is the structural chain of consequences. When a regional bank loses a significant portion of its low-cost deposit base, it does not simply shrug and move on. It is forced to replace that cheap funding with more expensive alternatives, Federal Home Loan Bank advances, Wholesale money markets, brokered deposits that carry higher interest costs. Every alternative costs more than the deposits it is replacing, which compresses the bank's net interest margin, the spread between what it earns on loans and what it pays for funding, which reduces profitability, which reduces the bank's willingness and capacity to extend new credit, which means fewer mortgages approved, fewer small business loans funded, fewer construction projects financed. The financial stress that begins as a number on a bank's balance sheet ends as a real-world contraction in credit availability for ordinary people in ordinary communities. One senior portfolio manager at a major asset manager described the primary loan market recently as feeling like, in his words, a ghost town. Recently deserted, a bit haunted. Not dead, but unmistakably quieter than it was. And when credit gets quiet, economic growth gets quiet along with it. And this is where everything changes. Let me take you to March 2023 for a moment, because what happened there has not been fully processed by most of the public. And it is directly relevant to understanding where we are now. On March 10th, 2023, Silicon Valley Bank, the 16th largest financial institution in the United States at the time, holding $209 billion in assets, collapsed in less than 48 hours. Not a slow motion decline, not a gradual erosion of confidence. A digital age bank run, executed primarily through mobile banking apps and electronic wire transfers, that drained the institution in less than 2 days. When federal regulators arrived on Friday morning, the bank was effectively gone. 2 days later, on March 12th, Signature Bank was closed by New York state regulators. 6 weeks after that, First Republic Bank, holding $213 billion in assets, became the third major casualty of that extraordinary 7-week period, 3 of the 4 largest bank failures in the entire history of the United States in 7 weeks. What made those failures possible? 2 things. First, over 90% of deposits at both Silicon Valley Bank and Signature Bank were above the $250,000 Federal Deposit Insurance Corporation insurance limit, meaning they were technically at risk in a failure. Second, and more importantly, the technology of 2023 meant that the moment doubt entered the conversation, depositors could wire their money out with a few taps on a phone screen. The old-fashioned bank run that required standing in line, filling out withdrawal slips, and waiting for a teller took days. The modern version takes minutes. The only thing that prevented a complete contagion across the entire regional banking system in March 2023 was an emergency, extraordinary decision by the Federal Reserve and the Treasury Department to guarantee all deposits at the failed institutions, even the uninsured ones that were legally not covered. A decision made under extreme time pressure to prevent systemic panic. It worked. The immediate crisis was contained, but the underlying fragility, the structural fact that digital-era bank runs happen faster than regulatory responses, was not resolved. It was managed, which is a very different thing. Most people are missing this. And here's the number that should make every deposit holder pause. The Federal Deposit Insurance Corporation currently holds approximately $128 billion in its insurance fund. The total deposit base in the United States banking system is approximately $17.6 trillion. That is a coverage ratio of less than 1%. Less than 1 cent guaranteed for every dollar deposited, assuming the unthinkable scenario of widespread simultaneous bank stress. This is not a criticism of the FDIC. It is the mathematical reality of how deposit insurance is designed to work, premised on the assumption that bank failures are isolated and sequential, not simultaneous and systemic. The question is, what happens if the assumption breaks? Now let me bring the present moment fully into focus, because the geopolitical events of early March 2026 have added a genuinely new and destabilizing layer to an already strained system. The military escalation involving United States and Israeli strikes on Iran has sent financial markets into a pronounced flight to safety posture. Energy markets have been severely disrupted. Global investors, who were already cautious heading into 2026, have shifted to a defensive positioning that is directly visible in the money market fund inflow data. The surge of $49 billion in the week ending March 3rd was not a random data point. It was the financial market's immediate visceral reaction to the possibility of a prolonged conflict in one of the world's most strategically critical energy regions. History gives us a very clear guide for what sustained oil market disruptions do to economies. In 1973, the Arab oil embargo against the United States triggered a recession that lasted nearly 2 full years and sent inflation surging to levels the country had not seen in decades. In 1978, the Iranian Revolution caused a second energy shock that drove United States inflation above 13% and forced the Federal Reserve to raise interest rates to nearly 20%, which then triggered another deep recession. In 2008, oil prices reaching record highs was not the cause of the financial crisis, but they were a significant amplifying factor that compressed consumer spending and accelerated the economic contraction. History does not repeat exactly, but it rhymes with remarkable consistency. And the pattern embedded in every major energy disruption of the past half-century is this. Sustained high energy costs are an effective tax on every business and every household that uses energy, which is every business and every household. They raise the cost of producing everything. They raise the cost of transporting everything. They raise inflation. They compress consumer spending. And they reduce economic growth. The convergence happening right now, record money market fund assets reflecting structural deposit migration, geopolitical energy shock accelerating the flight to safety, regional banking systems under quiet funding pressure, and a Federal Reserve that has already exhausted 3 rate cuts without reversing the trend, is not any one of those things in isolation. It is all of them at the same time. And this is where everything changes. So what does this mean for you personally? Because at the end of every macroeconomic story, there's a kitchen table. There's a Sarah checking her bank app. There's a real person asking, what does any of this actually mean for my life? Your mortgage, or your ability to get one, is affected. As banks face higher funding costs, they tighten their lending criteria. Qualification thresholds rise. Fewer applicants are approved. The people most affected are not the wealthy with large reserves. They are the first-time home buyers, the young families stretching to afford their first home, the ones for whom a 1% increase in a mortgage rate means the difference between qualifying and not qualifying. This tightening does not announce itself. It just quietly narrows the door. Your job security is affected. Small and medium-sized businesses, the employers of roughly half the American workforce, depend almost entirely on regional and community banks for their operating credit, lines of credit, short-term business loans, payroll financing. When those banks face deposit pressure and tighten their lending, the businesses that depend on that credit face their own squeeze. They hire less, they invest less, they sometimes survive less. The chain from a bank's balance sheet to a local business to its employees is shorter and more direct than most people realize. Your cost of living is affected. An energy shock driving oil prices sharply higher feeds directly into the price of gasoline, the price of food transportation, the cost of manufacturing, the cost of heating homes. These are not abstract financial market variables. They are the prices you pay every week at the grocery store and every month on your utility bill. The geopolitical situation in early 2026 is not an abstraction. It is already visible at the pump, and your savings, the money you have already accumulated, are affected by the structural reality that keeping it in an account earning 0.43%, while the broader market offers nearly 10 times, that is a slow-motion cost that compounds invisibly year after year until it represents a genuinely significant loss of what your money could have grown to. Most people are missing this. Now I want to be direct about something important, because this video should build your understanding, not your anxiety. Money market funds are not identical to bank deposits, and the differences matter. Bank deposits up to $250,000 are federally insured by the FDIC. If your bank fails up to that limit, your money is guaranteed by the United States government. Money market fund shares do not carry that same guarantee. In the financial crisis of 2008, a prominent money market fund called the Reserve Primary Fund saw its share price fall below $1 per share, what the industry calls breaking the buck, triggering a near panic that required emergency government intervention to stabilize. That has only happened once in the modern history of money market funds. But once is enough to understand that no financial instrument is entirely without risk. Money market funds that invest in government securities, treasury bills, government agency notes, carry considerably less credit risk than those investing in corporate paper. Understanding the distinction matters. Reading the fund's holdings summary, even briefly, is always worth the few minutes it takes. This is not financial advice. A qualified fiduciary financial advisor, someone legally obligated to act in your interest, not compensated to sell you specific products, is always the right first call before making any significant change to how you manage your money. What this video offers is context, history, and the honest description of forces that are already shaping your financial environment, whether or not you are aware of them. The informed investors in this story, the institutional treasurers, the pension fund managers, the corporate cash management teams, are not doing anything dramatic right now. They are not liquidating everything and hiding cash under mattresses. They are doing what prudent, informed financial managers always do in periods of elevated uncertainty. They are maintaining higher than usual levels of liquid reserves. They are diversifying their institutional deposit relationships, so no single bank failure creates a critical loss. They are shortening the duration of their fixed income holdings so that if interest rates move unexpectedly, they are not locked into long-term commitments at unfavorable rates. And they are paying closer attention than usual to the health indicators of the financial institutions they work with. None of those are panic behaviors. They are precisely the kind of thoughtful, boring, unglamorous risk management decisions that separate people who navigate financial stress from people who are blindsided by it. And this is where everything changes. One last time. Let us come back to Sarah. Because Sarah represents something much larger than one woman at a kitchen table. She represents the millions of Americans who are doing everything right by the old playbook in a financial environment that has quietly changed the rules without issuing a formal announcement. Sarah is not failing. Sarah is not foolish. Sarah is not behind. She is simply operating with the financial knowledge she was given, which was designed for a world where bank savings rates were reasonable, where the gap between a bank account and the broader market was a matter of a fraction of a percent rather than a factor of nearly 100, and where the structural pressures on the banking system were less acute than they are today. What Sarah needs, what every person watching this needs, is not fear. It is updated information. An accurate picture of the environment she is already inside of, whether she participates consciously in it or not. The silent bank run is not something that will happen to her someday. It is something that is already happening around her. The question is only whether she understands it. Understanding is not the same as acting rashly. Understanding is the foundation of all rational decision-making. The people who emerged from the financial crisis of 2008 in better shape were not the ones who predicted every detail correctly. They were the ones who understood the general nature of the risks around them well enough to make reasonable, defensive, thoughtful choices in advance, rather than reactive, panicked choices after the fact. If this video has added something to your understanding, share it with someone who you think deserves to know this, not to frighten them, but because the more people who understand the structural forces shaping their financial lives, the better decisions get made at kitchen tables across this country. Leave a comment below and tell me where you are in this story. Are you already using money market funds as part of how you manage your cash? Did any of this surprise you? Is there a specific angle, the regional bank pressure, the FDIC coverage gap, the energy market connection, that you want explored in more depth? I read every single comment, and your questions directly shape what we research next. Because here's the thing about this story. It does not have an ending yet. The $8.271 trillion sitting in money market funds will either gradually flow back into the banking system as the environment stabilizes, or it will keep growing as uncertainty deepens, as more retail savers discover the interest rate gap, and as the next unexpected shock further accelerates the migration. Which path it takes depends on forces that are still in motion. The geopolitical situation involving Iran, the Federal Reserve's next moves on interest rates, whether regional bank stress remains contained or begins to surface in ways that attract broader attention, whether the FDIC's coverage gap gets addressed legislatively, before or after it becomes a crisis. We are going to cover exactly that in the next video. The specific scenarios analysts are quietly modeling, what a genuine credit tightening looks like on Main Street, and what ordinary people, not institutions, not hedge funds, just ordinary people with savings accounts and mortgage payments and jobs, can do to make sure they are the ones navigating what comes next, rather than being surprised by it. Make sure you're subscribed, because this story is still being written, and the next chapter is the one that matters most.